Most people do not notice the cushion is gone until the day they reach for it. It may be a car repair, a dental bill, a home repair that cannot wait, an insurance renewal that comes in higher than expected. Nothing dramatic enough to make headlines. Nothing that looks like a crisis from the outside. But inside one household, everything changes for a moment. You check the savings account, then the checking account, then you think about the credit card, and somewhere in that quiet pause, the truth becomes clear. The money that was supposed to protect the household is not really there anymore. That is where financial stress often begins. Not with bankruptcy, not with foreclosure, not with one great collapse. It begins with the discovery that the cushion has disappeared. And what makes this so dangerous is that life may still look normal. The mortgage is current, the car is in the driveway, groceries are in the kitchen, the lights are on. From the outside, the household appears steady. But underneath that steadiness, there may be almost no room for anything to go wrong. According to the Federal Reserve's 2025 household data, 63% of adults said they could cover a $400 emergency expense with cash, savings, or a credit card they could pay off at the next statement. That also means a significant minority could not cover that kind of expense the same way. And for middle-aged Americans, a $400 emergency is rarely the only pressure sitting on the household. There may already be a mortgage or rent payment, a car payment, credit card balances, medical bills, insurance premiums, groceries that cost more than they used to, utilities, prescriptions, adult children who need help, or aging parents who need care. Behind all of it, there may also be a retirement account that should be left alone, but sometimes starts to look like the only place money still exists. That is why an emergency fund is more than a savings account. It is breathing room. It is the space between a problem and a setback. It is the difference between a bad afternoon and a balance that follows you for years. Bankrate reported in 2026 that 29% of Americans had more credit card debt than emergency savings. Only 44% had more emergency savings than credit card debt. That is not just a financial statistic. It is a picture of how many households are living, not only short on savings, but carrying debt at the same time. And once debt and low savings exist together, an emergency changes shape. With a cushion, a surprise bill hurts. Without one, that same bill can become a credit card balance, a minimum payment, and another month of feeling as if you are working only to stay in place. The hard part is that many people did try to save. They may have had an emergency fund once. Maybe it came from a tax refund, a bonus, overtime, or a few disciplined months when expenses were lighter. For a while, that money sat there and gave the household a quiet sense of protection. Then life started making withdrawals. The refrigerator stopped working. The car needed tires. A medical bill arrived. The home insurance premium went up. Groceries cost more. A child needed help. A prescription was more expensive than expected. None of these moments may seem shocking by itself. But together, they slowly take apart the account that was supposed to be there for the next surprise. This is the part many households understand, even if they rarely say it out loud. The emergency fund did not disappear in one emergency. It disappeared by surviving ordinary life. The Bureau of Labor Statistics reported that average U.S. household spending was $78,535 in 2024, or about $6,545 a month. Housing alone averaged $26,266 a year, about one-third of total spending. Transportation averaged $13,318 a year, or 17% of spending. These are not luxury categories, they are the basic architecture of American life. A roof over your head, a way to get to work, a car to reach the doctor, the grocery store, or family. These expenses are normal, but normal does not mean small. And normal does not mean harmless. For many households, the month begins with money already claimed. The mortgage or rent comes first, then the car payment, then insurance, utilities, groceries, credit card payments, healthcare costs, then something unexpected. And if anything remains after all of that, maybe some of it returns to savings, maybe. But when savings depends on what is left over, savings becomes fragile. Because real life has a way of leaving less over than people planned. And when a household has to choose between rebuilding the cushion and paying the bill that is due right now, the bill usually wins. That is the hidden trap. The emergency fund does not always vanish because someone was careless. It vanishes because every month asks for a little more than the household can comfortably give. Healthcare makes the pressure even heavier. KFF reported that in 2022, 41% of adults had debt due to medical or dental bills. West Health and Gallup reported that about 1/3 of Americans made spending trade-offs to cover healthcare costs. For older viewers, those are not abstract concerns. A dental bill does not always wait. A prescription does not always wait. A test, a copay, a deductible, or an out-of-pocket cost can arrive when the household is already stretched thin. And when healthcare competes with emergency savings, healthcare usually wins, because it has to. This is where credit cards quietly become the backup plan. At first, it feels practical. The car has to be fixed, the dental work has to be done, the insurance has to stay active, the household needs to get through the week. The card solves the problem today, but the real problem is not the bill itself. It is what remains after the bill is paid. Bankrate reported that 61% of card holders with credit card debt had carried that debt for at least a year. Among those with credit card debt, 31% had carried it for at least 3 years, and 21% for at least 5 years. For many households, the emergency ends long before the debt does. The car is fixed, but the payment stays. The dental work is finished, but the balance stays. The insurance premium is covered, but the card balance is still there months later. What began as a temporary solution becomes part of the monthly budget, and this is where many households begin to lose control without noticing. Not because everything falls apart at once, but because the minimum payment becomes normal. The balance becomes familiar. The household adjusts to the weight. That is how a family can look stable and feel anxious every day. They may have income. They may own a home. They may have decent jobs. They may not be spending wildly. But if most of the paycheck is already spoken for before it arrives, one surprise expense can reveal how thin the safety margin really is. The Federal Reserve Bank of New York reported that U.S. household debt reached $18.8 trillion in the first quarter of 2026, and that 4.8% of outstanding household debt was in some stage of delinquency. These numbers do not mean every household is in crisis, but they do show that debt pressure is part of the background noise of American financial life. For people in their 40s, 50s, and 60s, that pressure can feel different. There may be less time to recover, retirement may be closer, health costs may become more frequent, parents may need help, adult children may still need support. The idea of catching up later can become harder to believe. That is why the emergency fund matters so much at midlife. It is not only about whether someone can handle one bill. It is about whether life can absorb trouble without turning every surprise into debt. For many people, the fear is simple: we're okay as long as nothing happens. That sentence carries more weight than it first appears. It means the household is functioning, but not protected. It means the bills are current, but the margin is thin. It means there may be pride on the outside and worrying underneath. This is where money becomes more than arithmetic. It becomes silence. It becomes the conversation a couple avoids because both people already know the answer. It becomes the credit card statement left unopened for a few days. It becomes the quiet hope that the car keeps running, the roof holds up, the doctor does not find anything serious, and next month finally gives the household a little room. But many months do not give more room, they are simply survived. The emergency fund that disappeared tells a larger story about middle-class life. It shows how stability can become an illusion. A household can look comfortable because the payments are being made. But if those payments leave no space for surprise, the comfort is thinner than it appears. The trap is not always poverty. Sometimes, the trap is appearing comfortable while having no real cushion. That kind of pressure is hard to admit because it does not fit the old image of financial failure. A person may work hard, pay bills, avoid obvious luxuries, take care of family, do what responsible adults are supposed to do, and still, the emergency fund may be gone. Not because they never cared, but because ordinary life kept costing more than the cushion could survive. The most dangerous part is how slowly it happens. A savings account once had a few $1,000s. Then one repair took some of it, a medical bill took more. Higher groceries made it harder to rebuild. A credit card balance appeared. Then another expense arrived before the account recovered. Eventually, the cushion is no longer a cushion. It is a memory, and even then, the household may keep going. It adapts, it uses credit, it delays something, it cuts back somewhere. It hopes the next emergency waits, but emergencies do not always wait. This is not a message of blame. Not every household is in the same position. Some people have stronger savings. Some have lower debt. Some have more room in the budget. But the research shows enough financial fragility to make the pattern worth seeing clearly. The lesson is not that credit cards are always bad. It is not that one expense ruins every family. And it is not that there is one simple answer for everyone. The lesson is quieter than that. Financial safety is not the same as making the payments. A household can be current on everything and still be vulnerable. It can have income and still have no cushion. It can look stable and still be one bill away from stress. It can survive month after month while slowly losing the ability to absorb a shock. That is why this topic matters. The emergency fund often disappears before anyone calls it an emergency. It disappears when groceries rise and savings get skipped. It disappears when the car repair cannot wait. It disappears when healthcare costs force trade-offs. It disappears when debt payments become part of normal life. It disappears when every dollar has a job before the month even begins. And by the time the real emergency arrives, the protection may already be gone. For many Americans, especially those closer to retirement, that is a serious warning. Not a reason for panic, not a reason for shame, but a reason to look more carefully at the difference between looking stable and being safe. Because money problems do not always announce themselves loudly. Sometimes they enter through a small balance that stays, a skipped deposit, a repair charge to a card, a bill paid late, or a savings account that never quite recovers. Over time, those small moments become a pattern, and the pattern becomes the household's reality. The emergency fund that disappeared is really a story about pressure. Housing pressure, transportation pressure, healthcare pressure, debt pressure, the pressure of trying to maintain a normal life while the cost of normal keeps rising. And maybe that is why so many people feel tired. They are not just paying bills, they are managing risk every month. They are trying to protect the future while the present keeps asking for more. There are no easy promises here, no miracle shortcut, no single answer that fits every household, but there is value in naming the problem clearly. If credit cards have become the emergency fund, the household may not be as protected as it feels. If savings only grows when nothing goes wrong, it may never grow for long. And if stability depends on every month going perfectly, then that stability is fragile. The point is not to judge the people living this way. The point is to understand the quiet danger beneath it, because once a family sees the pattern, the stress becomes less mysterious. The anxiety has a shape. The feeling of being one bill away is not just imagination. For many households, it is the result of years of ordinary expenses slowly draining the space between them and trouble, and perhaps that recognition matters. A person is not alone because their emergency fund is smaller than they hoped. A family is not alone because a credit card became the backup plan. Many Americans are living inside the same quiet tension, trying to appear steady, trying to keep going, trying not to fall behind, while knowing one unexpected bill could change everything. The emergency fund did not always disappear in one dramatic moment. For many households, it disappeared quietly, one normal month at a time. And that may be the warning worth remembering. Sometimes the real emergency is not the bill that arrives. Sometimes the real emergency is discovering there was no cushion left when it did.